Well, we're at the end of another amazing edition of NYU IHIF. It's been a fantastic event. Alexei, could you describe the mood on the show floor?
Yeah, there's always a sentiment at these gatherings of an industry. 2,200 people. You really do get a sense for what the current sentiment of the industry is. And so with New York and the state of the U.S. economy, I mean, it's been an interesting last 3 months, right? I mean, Liberation Day was just on the beginning of April, and that certainly still has struck a mood.
Feels a long time ago.
Well, and I think that was a part of the theme that we're going to get in the U.S. economy, which obviously has an impact on the global economy, is that every day feels like something else is happening. Something is announced, it's pulled back the next day or whatever it may be. So what that's caused is a massive pause on the investment space. So any deployment of capital, any transactions that were about to be done have all stopped, right, for the most part. And pricing really certainly hasn't reset. So we heard that this last 2 days, that there's been a lot of pause that's gone on. That being said, we saw numbers from Matthew Lazzetti, the economist for Deutsche Bank. And what's interesting is that we continue to see this decoupling of data points, particularly macroeconomic data points. So one, consumer sentiment is down and continues to go down. We've seen that since Q4, but consumer spending is still up. And hasn't, sort of ran in correlation to consumer sentiment. You're starting to see, some impacts in markets on the leisure side, where, transient demand is going down, but groups and meetings are still very, very positive. And we really haven't seen a decline in RevPAR yet. So it's hard to sort of really get a feel for, is it bad, is it good? It really is just sort of in the middle right now. And yet it's really not that bad.
And so as we think about the near-term outlook and we take into account that historical experience, that's essentially what we're expecting from the economy over the next year. A slowing economy in the face of a very large tariff shock, but to be able to muddle through in the near term and a stronger outlook as we look out to 2026.
Where it's still muted is on the transaction market. But again, we've seen that for the last couple of years. There's still a lot of capital. There's still increasing demand for this asset class from others that have not been exposed to hospitality. And on the operating side, there's still a lot of good data that's coming out of the industry. So, I almost get the sense that that the industry would gladly take some negativity, like a recession, because it will at least prove that we're in one or the other. But it's the uncertainty that is hard to underwrite. And that's just the mood music right now.
It hasn't been that pressure from the lenders yet, or the LPs haven't asked for their money back as much yet. So there's still that people are holding on to the assets and not needing to sell. That might change soon, I guess, especially if things go south in the economy.
Well, look, we've been waiting for this since March of 2020. So we're past 5 years. Everyone thought that COVID and the complete disappearance of demand would be the trigger that would just unleash a wave of transactions. That didn't happen. Demand came back pretty quickly. Leisure demand, certainly. Then it was interest rates those were increasing. Before the interest rates, in fact, it was increasing costs, right? Increasing costs of labor. You had inflation. You had supply chain issues, interest rates. Then it was the tariffs, right? And it was the geopolitical. None of this has really had the impact that you would have expected on operating performance. You've got maturing debt, which is, continues out there, but there's tons of credit out there to refinance again. So nothing seems to really be the unlocking of it. But everyone does believe that it will probably continue to be slower through the second and third quarter. That there may be maybe 50 basis points of interest rate, maybe 25, some believe none. But at some point, we are going to start to see more transactions. It just has to happen. There's so much dry powder that's still sitting on the sidelines. And ultimately, there's a lot of CapEx that has not been deployed. And you're starting to see assets that just need recapitalization. They need new creative thinking. They need new operators. They may need a new brand, a new flag, and they certainly need money. And that's only going to come in, particularly if you're private equity. If you miss that window, you don't want to deploy capital right now. You want to exit
Yeah.
at a cap rate, tighter than what you got in. So something's going to unlock the market. I'm not sure what it is.
Well, Julie, as Alexa says, all that uncertainty kind of demonstrates the need to get together, doesn't it, do you think?
Absolutely. And it's something that we found at our other events, whether it was advisory board meetings, the executive planning committee last fall, or IHIF EMEA in Berlin a few months ago. At the time of uncertainty, you need to be engaged with what's happening in the market, to be ready to adapt when things become more certain or when an opportunity opens. You need to be in the room to be part of the decision. That's why this year at NYU IHIF, our theme was engagement drives return. We want to acknowledge the fact that people need to engage with the market to be ready when things pick up or when an opportunity opens, or to be the first to find a different way of doing business. And of course, it's also important from an events perspective. We wanted to create an event where people interacted more, where there were more opportunities to network within different sections of the market, different formats, and even create more serendipitous meetings and more interaction in the sessions as well. We had an incredible amount of engagement in the conference sessions, via the app, via the roundtables. People were happy to get together and talk.
Absolutely. And you put together a great program. And any highlights for you from a couple of days we had here?
Well, at NYU IHIF, it's the highlight has to be the CEO panel. It's the only event when you get the CEOs of the 6 top global brands together on stage with Sarah Eisen of CNBC, who's an amazing moderator and got an amazing conversation going. But also other side sessions. There was a panel on luxury that was really inspiring and really got to the different aspects of the segment, extended stay, and Matt Vizetti, the economist, was great.
I really liked Michael Bloom of Jefferies and Mitch Shaw. That was a sit down. It was right after the Capital Talk session, led by Jeffrey Horowitz of Proskauer, which again had a great panel and really dug into the fundamentals of what's happening in the private credit markets. What is going to unleash the transaction market? What are investors seeing in terms of value creation? It's hard, right?
It's going to be a rough ride. It's going to be hard to underwrite, but in the long term, I think what we're headed for is lower rates, a weaker dollar, which is ultimately better for the economy, and back to a period of growth.
There's a lot of dry powder waiting to be invested, and so overall, the all-in rate is pretty reasonable when you look at the broader backdrop.
Yes, there's chaos in the market, but we're still plowing ahead with doing deals. We have to underwrite them a little bit differently.
So now you've got recovering international, you've got still looming recovering BT demand. And it is actually quite a compelling story from a fundamental standpoint.
It is that there's a lot of discipline in this market. I think we're I think we're more of a mature market.
And there's other asset classes that are attractive. Data centers, offices coming in, but it's cheap. Retail the same as well.
Correct. But no one's going to deploy capital just because they have to deploy capital. So there's a discipline on the debt side and the equity side. What I was really excited about from the Michael Bloom and the Mitch Shaw conversation was that Mitt brought just an enormous amount of creativity to what he considers to be the market opportunity.
This really is a continued morphing of our industry into adjacent asset classes. When we're thinking about things, we're thinking about our core business and what drives performance going forward, understanding that there might be some dynamics that take place in the near term, but we really like the long-term secular demand trends as well as the supply picture. But then we also really like the fact that there's an opportunity to follow our C Corp partners into more of a living type of strategy that we'll be here a year from now, 3 years from 5 years from now. And we're not just going to use the words lodging and hotels. It's going to be an entire ecosystem, I believe, of things that's going to morph.
And the other area of creativity that we're really seeing is F&B. F&B continues to be a theme that it is no longer a department of a cost center, but it's a profit center. So I think there's a lot of creative thinking, energy, and new talent that's going to be coming into the space. So we've got long-term fundamentals are extremely positive.
Alexi, Julie, thanks very much.
Thank you.